This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why the chip giant Nvidia invested $2 billion more in the AI cloud computing startup CoreWeave.
Plus, a look at why a turnaround plan at the coffee giant Starbucks is starting to take hold.
But first, we begin in the auto sector. This week, General Motors released earnings that beat analysts' expectations.
The company also said it expects profits to grow as much as $2 billion this year and plans to return more of that money to shareholders with a higher dividend and buybacks.
For more, we're joined by Steve Mann, Bloomberg Intelligence Global Autos and Industrials Analyst.
We began by asking Steve to break down GM's EV versus gas engine portfolio.
Oh, it's actually ICE engines much greater. I know they have a full portfolio of EVs, but you're talking about like 85-90% ICE versus 10-15% EVs. So, you know, they do have a big portfolio, but it was just at the beginning of rolling them out. You know, they do still have one more major rollout coming out, which is the Chevy Bolt, a smaller vehicles, which the industry and GM thinks that that's where the market is going, a cheaper, more convenient EV.
Steve, it's almost to the point where the street rewards these companies if they not fully back away, but at least slow down the evolution to EVs and just focus on what's making money today. Is that kind of where the industry is today?
Yeah, exactly. Like Trump actually did the auto industry a major favor by relaxing the miles per gallon mandate. So basically, every vehicle in the big three's portfolio are currently meeting those mandates. And what it means is less penalties, right? And no need to buy EV credits going forward. Huge savings. And what that means is it could translate into a slower increase in car prices for consumers, especially for big trucks. Makes the big trucks a lot more attractive to sell for the big three. So they're going to sell as many as possible, given this opportunity. I know we talked about hybrid for GM. It's going to be a huge a sinkhole for them if they invest in that technology today. So let's not do that. Maintain whatever they can do with EVs and really push the ICE vehicles.
Maintain what they can with EVs so that, you know, small 10 to 15% of their overall portfolio. Forget about hybrids and just focus on mammoth gas guzzling vehicles. What happens then if gas prices do turn up higher unexpectedly? And I know that the administration is doing all it can to prevent that from happening, but I'm looking at AAA gas prices and they bottomed at around $2.79 and have now made their way back up towards $2.90.
Yeah. I mean, historically, when gas prices go up, it does impact ICE sales, and you know it may push some buyers into EVs. You know, depending on where the expansion of the EV charging network is at. But I think at the end of the day, if gas prices do go up, it actually benefits the Japanese companies like Toyota and Honda, where they have a full suite of hybrid vehicles that actually consumer love.
Yeah, I just leased the Honda CR-V hybrid. My son, who drives in California all the time, where the gas is really expensive.
Yes, that's right. He probably wanted it. And how often does he have to fill up?
Not that often. I mean, just not that often. It's great. It's a great technology. Steve, let's just, while we got you here, what's the call these days on Tesla? As we talk about this EV business, but really for Tesla, we're talking about so much more.
Yeah, looking at GM as a backdrop, you know, GM's earnings for 2026 is probably a little bit light. There's probably some more upside on the shift mix for more ICE. So what it means for Tesla, it's an uphill battle for them. I know the stock is trading, you know, at an astronomical valuation at the moment. Investors are very focused on their robotaxi autonomous vehicle build out. People feel that they can actually outcompete the likes of Uber and Lyft. So sales will be weak in the fourth quarter for Tesla, but I believe the investors are actually looking over past that into what is the catalyst, or what is Elon Musk going to talk about in their next earnings calls on the robotaxi.
Yeah, it's always about the Elon Musk narrative, his vision going forward of what this company is going to be. I wonder, Mary Barra talked about the charging infrastructure and the network and how we're not there in the United States. Tesla is offering the supercharger, and that's part of its business model, to be able to make that charger available to other automakers. How big a contributor is that to its revenue, to its profitability, when it's profitable?
It's still a small amount. It is what they do is they want to expand that business. So they are talking to gas stations like Wawa out in Pennsylvania are actually buying superchargers, installing it into next to the gas pumps and next to the stations. So they are trying to expand it. In terms of charging, selling these supercharging business and the revenues from the charging, it's still really small. I would say around 10%, maybe less.
Hey, what do we know about how important are incentives here? I look at other countries around the world, and they have got these huge EV percentages of sales. China, the Nordic countries. How important are government incentives to get there?
It is very important. I think the Germans are actually putting back the incentives, and it has lifted EV sales in Europe, in Germany. But at the end of the day, you really want to build a sustainable growth environment for these cars. And Mary Barr is right. We actually published a very extensive report on EV charging, comparing charging network in the US versus China, night and day, right? So, it's about convenience. It's about cost for the US consumer. It's great to have, it's great for consumer to have some subsidy, help pay for the cars that they're buying. But I think long term, it really needs the consumer to really buy into the product.
Our thanks to Steve Mann, Bloomberg Intelligence Global Autos and Industrials Analyst. We turn next to some news in the aerospace industry.
This week, American Airlines projected revenue growth for 2026, but said that the winter storm that raged across the U.S. this week will clip revenue this quarter.
We also heard from JetBlue Airways, who reported a wider loss than expected last quarter, highlighting challenges in a strategy to win over higher-paying customers.
For all of this, as well as other news in the aerospace industry, we were joined by Sid Philip. He is Bloomberg's chief correspondent for Global Aviation. We began by asking Sid for his take on American and JetBlue's recent results.
So the airline industry is actually in a sort of bit of a flux at the moment. I mean, you've obviously had the impact of all these storms. You've had the impact of the government shutdown, and you've got the uncertainty about the year ahead. And so American Airlines is taking a more bullish view of the year ahead. They're sort of following their peers, United and Delta, in targeting the most premium end of the spectrum. And they're sort of hoping that by aiming their product at the premium end of the market, they can sort of offset the sort of downturn that's happened at the bottom end of the market. JetBlue also talking about how at the moment things look a bit shaky, but they're talking about how they see a road to profitability and a free cash flow by the end of 2027. So slightly more long-term view of when the recovery might happen. And that sort of explains the dichotomy in the earnings forecast for both those companies.
And of course, JetBlue is also doing what it can to premiumize, if that's a verb, its experience for customers too, with the opening of that new lounge in JFK. So that is the story with airlines, and it's been fairly consistent too with what we heard from Delta and United. Where does that leave the smaller carriers that need to either team up or fade into oblivion? I'm thinking Spirit, I'm thinking Frontier. Is there still a market for these discount carriers?
So the market at the moment is very tough for the discount carriers. So essentially what's happening is that the top end of the market is going to Delta and United for their premium products like first class and business class. And on the other end of the market, you have sort of everyone else competing to get the lowest cost tickets into the hands of the passengers. And that's sort of eroding margins, especially as costs for both pilots and cabin crew are hurting the ultra low cost carriers and the low cost carriers. And that's sort of been explained by this K-shaped recovery that airline executives are talking about. And so JetBlue and the others are sort of trying to get the premium end of it. I mean, we've seen even Spirit Airlines talking about how they're adding a so-called business class product. They've added Wi-Fi, they've added all sorts of things to keep people coming back to them. And so they're hoping that by slightly differentiating themselves from just very commoditized ultra low cost carriers, they can be able to get in those customers.
Well, then it kind of goes back to the point, is there a need for a real true low-cost carrier out there? If some of these supposed ones are going kind of mid-market, higher market, is there a market demand for that, or is everybody just willing to pay up for travel?
At the moment, it looks the people who are willing to pay up for travel are the people willing to pay up for travel. And so at the bottom end of the market, I mean, everyone talks about how there will be a recovery of the ultra low-cost carriers, and that once people are more certain about the economy and once people at the bottom end of that K start to see some stability in the economy, people will travel. Because, I mean, remember during the pandemic, there was as we exited the pandemic, there was this boom in travel for across the board, and that sort of has further split up. And so we will see that demand coming back. We just don't know when and what sort of shape that will be.
So, Sid, you also cover Boeing, and it came out with its results. And in terms of the numbers for the fourth quarter, free cash flow topping estimates, it generated cash for a second straight quarter. That sounds like it's good news. How far along this recovery, this long-awaited recovery, is Boeing actually?
So Boeing is on the road to recovery. They're still not there yet, but they are recovering. I mean, their fourth quarter results and their full year results were boosted by the sale of their Jeppesen digital aviation subsidiary, and that sort of gave them a $9.6 billion boost. And at the same time, Boeing is sort of ramping up production. They are ramping up sales. I mean, they've seen a surge in sales. I mean, ever since the Trump administration came in, we've seen a surge in Boeing sales. And so Kelly Ortberg, the new CEO, is sort of pushing Boeing to improve production, ramp up production at a steady pace. I mean, they've gone to about 42 737 MAX jets a month, and they are sort of further boosting those production numbers, and that will get them at the sort of where they want to be. Kelly Ortberg talked about how $10 billion in free cash flow is his target, and the company's on its way there.
Our thanks to Sid Philip, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
Coming up, a look at why the wireless provider AT&T posted fourth quarter profit and revenue that beat Wall Street estimates.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move to some news in the tech space.
This week, we heard that the chip giant Nvidia invested an additional $2 billion in the AI cloud computing startup CoreWeave.
As part of the collaboration, CoreWeave will be among the first to deploy forthcoming Nvidia products.
We brought in Anurag Rana, Bloomberg Intelligence tech analyst, to tell us more.
We first asked Anurag for his reaction to this deal.
If you go back in history and see when CoreWeave was going public, it was having a hard time getting a good pricing. And then Nvidia kicked in and said, we're going to be a part of this particular IPO. And I think what's happening here is this. Nvidia is creating the chips, and CoreWeave is helping them sell the computing using those chips to different public that's out there. Now, at this time, CoreWeave has a massive backlog of orders, but it needs to get funding done in order to convert that into data centers and then capacity. Now, Nvidia isn't giving them money straight away, but it's basically saying, we have confidence in this company, and it would help. Then CoreWeave go out and raise capital from outside. So I think it's a little bit more like spreading the Nvidia ecosystem is that's happening right now.
Looking at your research note, you note that CoreWeave has $50 billion in remaining performance obligations. What does that mean?
Yeah, basically it says this is kind of the contracted revenue they have on hand, which means, Microsoft has said, I'm good for 10 out of that, for example. Meta has a deal with them. So they have this backlog of all these orders. But, unlike other companies, you just can't go out and fulfill the demand. You have to create a very large data centers using NVIDIA chips. It then starts to work or runs, and then you realize that 50 billion into revenue over the next several years.
So what's the gating issue here for CoreWeave? Is it more access to more data centers? What's kind of the gating issue for them to fulfill that revenue?
There are multiple gating factors. One is actually the data center itself. For that, you need land, you need power. The chip side is okay at this point because Nvidia is there, but then also you need capital. I mean, CoreWeave is not a company like Microsoft or Amazon that has unlimited capital to create these data centers. It has to go in the market and raise capital. Before they went public, I mean, their cost of capital was north of 10%. Right now, after they went public, I mean, the cost of capital has gone down to about 8%. But the entire neoclouds arena, whether it is CoreWeave or whether it is Nebius, really depends on private credit lending or lending by other banks to really come up with the funding to create these data centers.
So I also see that Microsoft unveils latest AI chip to reduce reliance on Nvidia. What's going on there?
So this is something that's going on with all hyperscale cloud providers, whether that's Google with its CPUs, Amazon with its chip, and now Microsoft launching. I mean, they have one chip, but the first generation was not, you could say, did not do that well in terms of, reception from customers. What Microsoft is hoping here right now is, for training, they'll still use the more powerful NVIDIA chips. But for, running, let's say, a Copilot, they could get around and use less powerful chips, and if they do that, they actually save a lot of money. In our math, we think if Microsoft is going to spend, somewhere north of $140 billion this year, more than 50 of that is going to go just buying chips. And so, it's a very big ticket for them, and everybody needs to be doing this, frankly, in-house.
Our thanks to Anurag Rana, Bloomberg Intelligence Technology Analyst.
We move next to earnings from the coffee chain Starbucks.
And this week, the company reported global sales at established locations rose 4% in the most recent quarter. That topped analyst estimates.
For more, I was joined by Michael Halen, Bloomberg Intelligence Senior Restaurant and Foodservice Analyst. I first asked Michael to break down how CEO Brian Niccol's turnaround plan is going at Starbucks.
The turnaround plans are starting to really take a hold right now, and results really improved, rising 4% system-wide same-store sales, U.S. as well. China was up 7%. Here in the U.S., it's mainly about better operations, right? They rolled out new operating standards late last year, and that they seem to be really boosting the speed of service, which is creating happier customers that come back more frequently, right? Some food innovation, including protein cold foam, seems to be hitting the mark, right? And they're doing a better job on the marketing side. So all those drove better same-store sales than expected.
Yeah, I don't know. The one I go to, the Starbucks, Route 35, Wall Township, New Jersey, they do a great job for me. And I've noticed the change. I mean, little things like, writing your name back on the cup like they used to back in the early days, as in addition to that sticker, which was a little antiseptic, I guess. Talk to us about costs there. Are they looking at their costs as well?
Yeah, they've identified $2 billion in annual costs that they want to get after over the next 1 to 2 years. Right now, margins have been impacted. They've gotten those same-store sales and traffic numbers up by adding labor to the stores, right? And so they're seeing margin compression still. So now that they got people coming back to the stores, now that the operations are more dialed in, CEO Brian Niccol said they're not quite where they need to be throughout the day. They're great at peak, but they have some improvement still to do. But, now that people are coming back to the stores, they're going to focus a little bit more on where they can save some money, because, it was a smart move reallocating labor into the stores, but costly.
Talk to us about the competitive environment, because you go to small towns. It seems like there's a coffee joint on every corner these days. What's the competitive landscape for Starbucks these days?
Well, it's as competitive as it's ever been. You have some of these younger chains that seem to do really well with Gen Z, like Dutch Bros and Seven Brew, and they're opening up these drive-through cans, throughout the suburbs across America. In the cities, there's a lot of competition with these, very high-end coffee shops that are using very high quality coffee and offering an elevated food experience. So competition is tough, and that's why Starbucks is making some changes. They're focusing on health and wellness, right? They're looking to improve the food in the bake case. They're looking to improve the food throughout the day. They're looking into some new innovative drink offerings to boost that afternoon day part. And so, this is just the beginning of what Starbucks, thinks they need to do for long-term continued same-store sales growth.
Our thanks to Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst.
We move next to the telecommunications space.
This week, AT&T reported fourth quarter profit and revenue that beat analyst estimates.
The results were fueled by customers who subscribed to more than one connectivity service. AT&T added more than 500,000 fixed and mobile internet subscribers in the quarter.
So we brought in John Butler, our senior telecom analyst, and began by asking John where AT&T stands relative to its rivals.
Post the earnings call, they held a breakout session with investor relations with the sell side, and there were a lot of questions about how broadband or how competition is now shifting from wireless over to broadband. I actually think AT&T is in a great position relative to their competitors because they're the fiber leader, and they're about to buy Lumen's fiber business and add another 1 million fiber subscribers there. So in terms of their ability to sell what are called converged packages or wireless together with broadband, they're in a great position there because they have both fiber and they have a smaller fixed wireless access business, which is that wireless broadband product.
John, this is a company, AT&T, that spends $22 billion in CapEx every year. What is that CapEx for typically?
A lot of it, Paul, is going towards wireless network upgrades as well as the deployment of fiber. So this year, for example, they're going to add 5 million new fiber homes, but it costs about $2,000, maybe twice that in some markets, to build a new what's called a fiber homes pass. So a lot of capital is getting spent this year, next year, and maybe to a little bit of a lesser degree in 28. That's sort of laying the foundation to build out that fiber network and that 5G wireless network. Beyond that, AT&T has said we're going to cut our CapEx. We're going to lower our capital intensity, and you're going to see a lot more free cash flow through. And they're going to be able to fund hopefully some dividend growth after that and increase the share buyback.
Yeah, I'm looking at the dividend yield for AT&T, 4.6%. For Verizon, it's almost 7%. For T-Mobile, a little bit less at 2.19%. John, where do the telecoms stand when it comes to this rotation out of big tech, looking for some cyclicals, looking for parts of the market that haven't been overbought?
So it's a good question, Scarlet. I always say telecoms, particularly the dividend payers like AT&T and Verizon, are bond proxies to a degree. I think sentiment has been pushed around a little bit by the fact that we have new CEOs at both Verizon and T-Mobile, and these guys are going to be looking to make their mark. So there's been a little bit of concern, or more than a little bit of concern, that the competitive intensity in wireless is going to pick up as these new CEOs look to make their mark. And I think that has led to some of the pressure, particularly on AT&T, though, again, I think they put a lot of those concerns to rest by reiterating their fiber plans and laying out new free cash flow guidance.
John, on the competitive land front, where are the cable companies these days?
They're struggling, Paul. I mean, they're at a technology disadvantage in that they're offering broadband over those legacy coaxial cable networks. They're doing what they can to upgrade the technology and increase speeds on those networks. But at the end of the day, fiber really is a superior product to everything else on the market. And fixed wireless access, which has been offered by the telcos, has been a very popular choice given the fact that it's an easy setup. It's over the air, so there's very little problems with it. It's pretty much problem-free as broadband goes. Over time, it sort of has a headroom problem. It can't offer the same speeds as fiber. But through it all, cable is sort of flying underneath those two products, sort of, trying to compete with what is a legacy product in the market.
John, did we learn anything from AT&T's results regarding iPhones and consumers signing on for the latest version of the iPhone?
So, great question. It's very interesting. AT&T over-indexes to the iPhone. They have a lot more users than Verizon or T-Mobile because they had an early exclusivity deal when the iPhone first launched. They were asked about the foldable iPhone that's rumored to be coming out next year and whether that's really going to move the dial for them. Their answer to me was interesting. I didn't expect it, which is they've been tracking the performance and the sales of the foldables that they have available on the network on the Android side. And their expectation is that we won't see a huge bump in iPhone sales next year. I think time will tell. I actually think foldables are going to resonate well with people. And Android isn't always the best read through there. I think it's a different kind of user that's on the Android phone versus iPhone, but we'll have to see in the fall.
Our thanks to John Butler, Bloomberg Intelligence Senior Telecom Analyst.
Coming up, a look at why the logistics company UPS says it expects to cut another 30,000 jobs this year.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence through BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move next to news from the logistics company UPS.
This week, UPS forecast full-year sales that beat analyst estimates.
However, the company also said it expects to cut another 30,000 jobs this year to rein in cost and boost profitability.
For more on this and the state of the shipping industry, we brought in Thomas Black. He's a Bloomberg Opinion columnist.
We first asked Thomas to give us his take on what we heard from UPS.
UPS continues to shrink to become more profitable. That's the big takeaway. They're reducing their Amazon business, and they're trying to retrench with more profitable packages. And that's probably a move away from some of the e-commerce deliveries where the competition is fierce, and there's lots of little companies that are out there competing.
So how far along this journey of shrinking to become more profitable are they? Are we in the third inning? Are we in the seventh inning?
This will be the last year of this. So I would say we're in the sixth inning heading toward the ninth. So after this year, Carol Tomé, the CEO at UPS, said we're going to be a leaner company and ready to grow. So it's going to be a little bit painful this year. She walked analysts through it. The first half is going to be more painful as they glide down from Amazon and they take some write-downs and so forth. As you know, they retired their fleet of MD-11s, which is this old plane that just sad. Recently had a crash. So they're going through all of this in the first half, and then the second half, things should start to turn around. They're not only shrinking their Amazon business, they're shrinking their footprint, their facilities. And the older ones are being retired, and they're replacing those with new automated facilities, and that's going to allow them to lay off more union workers. So that big union contract where the Teamsters pushed through a big labor increase is turning around to bite them a little bit because UPS is dealing with that by shrinking its workforce.
How does this UPS strategy differ from that of FedEx?
They're similar in the sense that they're both cutting costs aggressively. FedEx is a little bit different because it doesn't have the labor costs from the union workforce, so it's a little bit more flexible. And FedEx is undergoing a major overhaul that's probably in its last innings as well. And the last part of that is the most difficult part, where they're going to combine their two separate networks, the ground network and the express network. They're in the middle of that, but so they're going to be coming out of that as well. So we're going to have two parcel companies that are restructured and ready to grow at the end of this year.
Every time there's some kind of headline regarding UPS laying off workers or cutting positions, it's these massive numbers, right? This time around, it's up to 30,000 positions this year. And as you mentioned, Thomas, this is all due to trimming down and downsizing the scope of the company. At what point are we looking at job cuts tied to AI, or have we not even gotten there yet?
Well, I would, instead of saying AI, I would say automation. And those are these new facilities that handle packages automatically. You even have the induction of packages where you have robots putting the packages on the conveyor belts and taking them off. So those are the steps toward more automation. This is that physical AI that people talk about, right? And an interesting stat that Carol Tomé gave on the call is that those automated buildings are 28% more efficient than the older buildings. So the more automation is where they're leaning into. So it's part of it shrinking some of the low profit volume plus more automation to replace the human workers, basically.
E-commerce continues to grow, I guess, double digits. Who's handling all these packages if UPS is maybe backing away a little bit?
Well, Amazon has its own delivery network.
Yep.
It tends to want to deliver into those big urban areas where it just takes things from a warehouse to a residential home. So they do that very well. Where they want help is on the rural areas. That's where they turn to folks like UPS and the Postal Service. So obviously Amazon is a big player there. We also have lots of smaller companies. These are gig type companies that have apps and workers show up and they have an app on their phone and it gives them a delivery route and they throw packages in their car or their truck and they go deliver. So there's a lot of those companies that tend to operate in urban areas. So there's actually a lot of capacity out there for retailers or people who are really smart on their inventory management to tap into.
That was Thomas Black, Bloomberg Opinion Columnist.
We move now to a Bloomberg Big Take story we recently focused on entitled Yale's Endowment Model Falters at Tough Moment for Universities. You can find it on Bloomberg.com and the terminal.
So the story looks at how Yale bet on private equity and other illiquid investments. And now some of the wealthiest endowments, including Yale and others that follow the Yale model, are on the hook for hundreds of millions of dollars in new endowment taxes from the White House.
Now universities are dumping private equity funds at discounts following years of poor returns, while public stocks have outperformed the asset class.
For more, we brought in Janet Lorin, Bloomberg's higher education finance reporter.
We first asked Janet to break down what is happening with Yale's endowment model.
From time to time, we've seen that in certain years where Simple just outperformed private equity and other and VC. And in 2021, remember the outstanding returns that these schools had. But now, higher interest rates, fewer exits, you've got a huge amount of money locked up in private equity, in some cases 40%. And, look, these schools would like a little cash. They're looking, perhaps they want to change managers. They need the cash to do other things as well and refresh their portfolios. But when you have, in the 40% locked up, time to think about other things. And that's perhaps why you saw Yale doing its first ever sale last year, which was a big deal.
So again, this sale, Yale unloaded about $2.5 billion in LBO funds at a discount. That is brutal.
Well,
is that unprecedented or other folks?
Yale has done it for the first time. Others have been doing this before. Harvard has unloaded a lot in previous years, but it's sort of a new normal in some ways. Looking at secondaries, the secondary market is very popular right now, and they in the hunt for potential cash and liquidity. You look at the UC endowment where we talked about this 80-20, they call it the blue and gold fund, very proud of it. And in the height of the pandemic, when they wanted some liquidity, they gave almost $2 billion in cash to the campuses for liquidity. Compare that to 2008 when schools were forced to sell on the secondaries or borrow. That's kind of a stark example right there when you need money.
When you need money, and I think that's a key phrase here, especially in 2026, because this White House has been targeting higher ed. And even though Yale has not been targeted to the extent that Harvard has, for instance, or Columbia, these schools need money in a way that they didn't before, if for nothing else, to pay taxes on their endowment.
Yes, and that's a huge game changer. A year ago, we may not be having this conversation. Yale and Harvard each had pegged their bill for the endowment tax, which is now 8% of net investment returns, to be about $300 million a year.
Wow. And is that in force? Is that happening right now?
Absolutely. That happened July 1st when the big, beautiful act happened.
How about the actual, halting payments to some of these universities that President Trump and the administration have talked about for some of their funding? Has that happened?
So many schools have had settlements. Harvard famously has not yet. There was a lawsuit in last September. The district court ruled in favor of Harvard. Late December, the government appealed. So that's still in flux, but there's a huge concern of Harvard and all universities. Are we still going to get this federal research funding going forward? And Harvard may have temporarily solved their problem, still very unclear. But what is the money going forward? Are universities, these large research universities, still going to be able to count on hundreds of millions of dollars? Northwestern, which settled around Thanksgiving, had been self-funding their research to the tune of something like $30 or $40 million a month. So we're talking, lots and lots of money.
Yeah, they need the money in a way that they didn't before. And going back to the Yale endowment strategy and how well it worked, at least initially, when David Swensen launched it back, I think, in the 80s and
Correct.
90s, those were the heydays of the Yale endowment model. Maybe it made sense when private equity, private investing was not a big thing yet, was not yet mainstream. Or maybe it makes more sense in a low rate environment. But times have changed, and that's a big part of it, right?
Absolutely. First mover advantage. There weren't as many institutional investors doing what he was doing. He saw inefficiencies in the market, and he said, look, this is what we can do. We have the ability to lock up money for a while. We're very long-term investors. We invest for centuries. We can do this, and it was extremely successful. And others tried to copy. Certainly more money piled into private equity, sovereign wealth funds, pension funds, foundations. And when you have a lot of money chasing returns, it just isn't as successful, especially at this higher interest rate when there are fewer exits.
What is the Yale model in terms of asset allocation, and is it dead now?
Well, we had the head of a very large pension fund say it's not dead, it's perhaps on life support. But it's, it's looking at inefficiencies in the market. Now, typically, Yale has not been a big investor in U.S. equities. Tiny share of, we don't know the details because unfortunately they stopped publishing their asset allocation when David Swensen died. A huge loss for me personally
Right.
because it gave you some great insight.
Yeah.
But they, typically had a very, very tiny investment in U.S. equities. Now look at the University of California, 80% in global equities, but who are they trying to emulate? Some investor in Omaha who's been pretty successful.
Yeah.
Betting on America.
Yeah, but just buying cheap index funds. I guess what's not immediately obvious to people is that an endowment is more of a fund of funds rather than just a fund. Like the UC fund, the blue and gold fund you were talking about, that's almost like a very basic personal account where you're just putting money into index funds and not dealing with it for a long time.
Exactly.
But Yale is like, they're picking fund managers, like it's very, very complex.
Well, it's actively managed. And Yale is very famous for, having managers for 10 or more years. I did a story maybe 10 years ago that talked about the length of managers, and it's often 10 years. And, Yale very smartly came up with a new program. They call it the Prospect Fellowship, and they're looking for new talent. And we had a comment from a former Princeton manager who talked about, they look for talent and they grow with them. So maybe a small allocation to a manager today, think Hill House at Yale, it turns when they're successful into, billion-dollar investments, and especially when they've done well. You can grow with a successful manager, and then all of a sudden your allocations are much larger as you're growing with them. And that's what they're seeking. So that's sort of like a refresh for them.
That was Janet Lorin, Bloomberg's higher education finance reporter.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.